Okay, let's go. So I'm doing a quick video instruction, hopefully this will be in just a few minutes, on how to actually measure a property investment and to know what you should be measuring, when to negotiate, what to negotiate, know what you actually should be measuring, and know what you actually want out of the investment. So I'm going to use a dollar-based system just because it's easier to measure in dollars than anything else, and we're going to play with some of the variables. So first thing we want to do is know what to measure. Usually what people do is they measure the return on investment at this level. What are you funding in a particular investment, and then what type of return are you getting on that money? I want to shift the thinking a little bit and say, what is the SPV, the special purpose vehicle that's going to be holding the property? Is it a trust? Is it a limited company? Is it a PDY limited company? Is it a LLC in the US? Whatever the case may be, you need to measure this entity's return on investment as well as your return on investment if you're supplying any cash into this SPV. So you can become a second bank if you want to think of it like that. So in order to measure that, you've got to decide what you want your money to cost and what kind of return on your money do you want. So let me show you some examples. What we're going to be doing, just to get the right mindset, is we're going to be measuring the return on investment on this SPV. So this SPV needs money, and its purpose is to buy a property. We also need to decide how long this purpose is for. Is it going to buy it for the long-term growth? Is it going to buy it for income purposes? Is it going to buy it to hold it indefinitely and pay it down and then just collect rental income? What is its purpose? So that's for you to decide. I'm going to say in this particular case, its purpose is to buy a good quality asset that over time will generate rental income so we can live off the rental income instead of off our blood, sweat, and tears in a work environment where we sell our time for money. So let's have a look at some variables here. Number one, what's the purchase price of the property? And I'm going to assume all closing costs are included because in every single country in the world, you've got to pay some sort of closing costs, and a lot of people don't like measuring them on the investment. If it costs you money, put it in the damn calculation. So I'm going to assume that it's all in on that particular purchase price. Then what is our loan to value? So how much physical cash are we putting in and how much are we borrowing from the bank? What is the interest rate we're going to be paying? Over what term is that payment? What is the rental income? How much are we paying for management? In this case, it's 10%, just for illustrative purposes. What is our vacancy allowance? In this case, it's 8%. What's our annual growth forecast? In this case, it's 8% again. You might want to revise that down if you're buying in London, or you might want to revise it up if you're buying in India. I don't know, depends. Play with the spreadsheet. How long do you intend to hold it? I've done a 5-year forecast for in terms of internal rate of return, and I'll go into that in a second. What are the rental escalations going to be, and what are the expense escalations going to be? Other expenses, so insurance, property taxes, that type of stuff. You can obviously add in any capital expenditures over the period. So if you're going to go and spend another $20,000 on a renovation in year 3, then you've got to add that in somewhere in the spreadsheet. I'm trying to keep it light and simple on the spreadsheet so it's one view and you can see what kind of outcome. What's our cost of sale on the property? So if you have to pay an estate agent or anything like that at the end when you actually want to sell it, I'm bringing in a cost of 7% over there. And that brings us to an internal rate of return over 5 years. Now 5 years is a very key point because what happens is we have some rental escalations that come in, so your cash flow increases. Your expenses obviously increase a little bit too. And then you've got a sale event that I've put in for us to measure the actual internal rate of return. Now what's key about this is the internal rate of return is the sort of common denominator to measure any investment, because this is your growth factor. This is how fast your physical money is going to grow. What's important here, when I say your physical money, I mean the SPV's money. So how much is the SPV's money growing? So let's take a look at this. What's interesting here is you can create a negative cash flow property. You'll see here, if we take the rental income, less the management fees, less the vacancy, less the expenses, less the bond repayments, we actually have a negative cash flow situation happening over here. So we want to be able to measure how much physical cash is coming out of this SPV's pocket over the 5-year period to give us an internal rate of return number, so that we can compare that against a REIT or a hedge fund or a stock or a business's growth or anything like that. So once we know the internal rate of return, we've got a number that we can compare apples with apples or oranges with oranges, so to speak. So if we go along here and look at what happens on this side of the spreadsheet. So this is very simple. It's the rental income in year 1, and then it grows by 3% because that's what we put in over here. The rental growth was 3%. Then all of the expenses that also grow by 3%. What our bond repayment is over time, we're taking into account that this is a principal and interest payment. So we're paying it down over time. It's not an interest-only bond. Obviously, your cash flow would increase if it was an interest-only bond. But for this purposes on this video, let's just say we're paying down the bond and it's not interest-only. That gives us a net income amount. Now this physical cash laid out. So this is how much money this is physically cost you to buy this property. So we want to know what is the growth on that money. This takes into account our exit price at a growth point, annual growth of 8% and a cost of 7%. There's our cost of sale. There's our settlement figure on the bond, giving us a net profit of, in year 1, $1,200, $17,000 in year 2, $35,000 in year 3, $54,000 in year 4, and $75,000 in year 5. So if we take all of those into account, in terms of our cash flow and our exit price on the internal rate of return calculation, that gives us a yearly number. Year 1, 4%, 6% year 2, year 3, 9%, year 4, 10%, year 5, 10%. What's extremely important over here is playing with the variables to figure out what you should negotiate and when you should negotiate. So for example, if I had to ask you, if you were buying a, let's look at this exit price point here, $270,000 property, or in year 5, call it a $293,000 property, and you physically laying out $101,000. So that's how much the property actually cost you. Is that a good deal or not? I would say yes. That's a almost 70% discount. So I would buy properties like this all day long because that's how much physical cash I've laid out. So I know that if I just wait for the property to be paid down by the tenant, I will have a $300,000 property, and as it grows at 8% per year over 20 years or 30 years when this thing's finally settled, it'll be worth a hell of a lot more than that. But I physically only laid out $100,000, and as you can see, it's actually coming down. That's because as the rental grows, the physical cash that I've laid out is shrinking. So this is an extremely important thing to get into your mind. Let's play with some variables and see what actually happens here. So we're buying a $200,000 property and we are taking a 70% loan to value ratio. So we're physically laying out 30% of the cash required for this property, and a good interest rate in the US would be 6% over 30 years. Keep all the standard, the rental incomes the same. Now what's important here is, can you add value in some way, shape or form to increase the rental income? So for example, if you said, okay, this property was $200,000 in cost price, but if you added another $50,000 to it, and we increased the rental income to, what was it before, it was $1,333. So if we added $50,000 to it, and we could increase it to $2,000, immediately our internal rate of return would go up. So this is where you can start playing with what you need to think about in a property investment. So when you're walking in and you see, okay, we can add a conservatory or whatever the case may be, then you say, okay, well, let's capitalize that cost. So let's add it to the cost of the property. Let's add the extra rental income that we could get out of it by doing that addition. And then does the internal rate of return go up or go down? So for example, if that cost $250,000 in total, and we could only get $1,700 for the thing, then we've got a 20% internal rate of return. So if we go and undo those quickly and go back to the original, we had a 19% internal rate of return. So we're pretty close. So we know that adding the addition at an extra $50,000 was worth it, as long as you're financing a portion of it. So all of these factors come into play on what you should be negotiating for. Can you increase the rental income or not? If you're adding extra money, what is that money costing you? And then what's the knock-on effect on your internal rate of return and your cash flow? This negative figure here obviously needs to be funded from somewhere. So what happens is typically you fund that into the SPV via a loan account. So we're measuring the SPV's internal rate of return and your return on investment on that $60,000 that we're physically laying out in this particular example. So let's say we're buying an average property in America like from IPS. So we know that it's $200,000 property would get you, I'm saying 8% cash on costs, so that's $1,300 is about right. Management's about right. Annual growth 8%. I would say let's shrink that to 3% at the sort of national kind of inflation rate. If we're going to hold it for 5 years, we're going to have 3% rental escalations. That's probably a little bit higher. Let's put it in 2.5%. That's about right. It's about 1.2% for insurance and about $800 for taxes. And currently borrowing 9.75% over 15 years. I think it's 20 years actually. So we can see there's our monthly repayment. This is how much negative cash flow we're sitting in a situation if we had 70% loan to value. So in the US, we can get up to 60%. So let's see, where do we stand now? In year 5, we're sitting on a 3% internal rate of return. Not fantastic. I don't know if I would want to buy this particular property. So what could we change on this to get it a better deal? So let's change the interest rate. Let's say we can get better money. So interest rate at 6% over 20 years. Immediately now we've got a higher internal rate of return. Let's take another example. Let's say we could theoretically finance the entire amount. So let's say we get 100% loan to value. So this is closing costs, everything. Look at what happened to the internal rate of return. Went up to 15%. Because what it's doing is it's measuring how much physical cash we're laying out in order to acquire this property. So in year 5, we've laid out physical cash $6,244 because that's the negative cash flow cumulative over the period. With our exit price, we're looking at a 15% internal rate of return on our money. So our money is growing faster because we're able to finance more of the property. So now the question is, if you have to put down a 30% deposit, could you find the balance of the money somewhere else? So if you found it via a loan, so if you said, okay, well, what I'm going to do is that $60,000 that's required. Oh, I'm in the wrong place over here. So this 60,000 is going to be funded by you, this entity over here. Then what's your return on investment going to be? So you could theoretically charge the same interest rate, 6%. So your return on investment is technically 6% a year if you decide to charge the same interest rate. But what happens then is that this entity's level, you've suddenly created 100% finance because you're financing 60,000 and the bank's financing 60,000. So immediately what happens is you actually have to measure the SPV's return on investment at 100% financing because you've loaned the money and the bank's loaned the money. So this thing got money out of nowhere, and now we want to know how fast is it growing at 15% per year. Fantastic. So you funded the 60,000 in here, and then this SPV had to find another, whatever it was, $6,244 in order to meet its demand. So its money grew at 15% a year, which is quite good. Now let's say, for example, we're sitting in a situation where you can get very cheap money like the UK. So let's say we can get a 3% loan over 30 years, but let's change some dynamics. So we know that you can't get an 8% yield in the UK. We can get a 4% yield. Management 10%, about the same. Vacancy 8%, that's about the same. That's 1 month per year. Annual growth 3%. Let's say we can get a little bit better than that if you're buying anywhere around zone 1, zone 2, maybe 5%. Escalation in rent 3%, that's about right. I think there's some extra taxes and stuff if we had to take that into account. So let's add an extra $1,000. Now we're sitting in a situation where we minus 24%. Oh, it's because I added $1,000 a month. Let's just add $100. My mistake there. So now we're at 21% internal rate of return. So immediately now you can see buying in London on numbers like these would make a lot more sense at 21% growth per year than it would at 15%. But the key here is to say you want infinite. So what does that look like? So what that looks like is you say, okay, we've got 100% funding, but we're running at a negative cash flow. So we need to increase the rental income. And we need to increase it by about, call it £100, $100 a month, whatever you want to call it. So by increasing the rental income, our internal rate of return has gone up, 28%. But let's say we could do it and get positive cash flow from day one. Now I need to get positive cash flow, damn it. Just for illustrative purposes. So the second you see that num there, that means it's broken, it can't measure it, which means it's infinite. That's what I look for on every single one of my investments. How to get a free property. When you see that, you know you've made it. So how does that typically happen? The bank supplied some money, you've supplied some money, the SPV is generating a positive cash flow from day one. So if we're able to generate a positive cash flow from day one, with no money laid out, from the SPV's perspective, we've generated an infinite return on investment. So find a property that you can modify that will produce an outsized rental income where you can get 100% financing in some way, shape or form, and the rest of the numbers kind of take care of themselves. So the key factor here is, let's say we could get an average property. I don't know what average properties go for in the UK, but let's take this back to America and say it's a property like RJ lives in at the moment, where Anthony and RJ are both renting that property. So let's look at the returns on that. $200,000 annual interest rate, let's put it at 6%, 30 years, and we know that that rental is about 0.8 for a standard house, and the basement is easily $800 a month. Growth 5%, let's put it at 4%. Hold period in years, it actually doesn't matter because we're still at an infinite return. So we've laid out no money and we've got positive cash flow by doing one little thing, renting out the basement. And that's how you create infinite returns. You measure the SPV's return on investment and where it's getting its money from, and then on your side, you're saying, well, I'm charging an interest rate on my money, so I'm generating a 6% return on investment on my money because I'm charging an interest rate to supply the balance of that financing. Obviously, if you can get this off of a credit card, or if you can refinance another property and get it out, anything where you can create this money out of another entity to supply to this entity, you've immediately created 100% financing. And that's it.